Jesse Livermore, it began in the chalk-dusted air of a stock brokerage office, where as a boy, just out of grammar school, he took a job as a quotation board boy. He was not a trader, not an investor, not even a student of the market in the conventional sense. He was a boy with a prodigious gift for numbers. He had completed 3 years of arithmetic in a single year at school, a testament to a mind that saw the world in figures. From 10 in the afternoon, his world was the big board and the numbers that flickered across it. To him, these were not prices of stocks, not dollars per share representing ownership in great enterprises. They were simply numbers, numbers that were always changing. And in that constant change, he found his first fascination. Why did they change? He didn't know and he didn't care. His only interest was in the behavior of the numbers themselves. His remarkable memory allowed him to recall in vivid detail how the prices had acted just before they went up or down. He began to see habits, patterns, parallel cases that formed precedents to guide him. He was not yet 15, but he was already learning to read the language of the tape, not as a record of transactions, but as a story of probabilities. He kept a little book, not to record imaginary millions, but to test the accuracy of his observations, to verify if he was right. His private study soon found its first practical application. A fellow office boy armed with a dandy tip on Burlington needed this wasn't about doubling his money, it was a chance to test his theories in the real world. He consulted his little book. His figures confirmed the tip. Burlington was acting as it always did before it went up. He pooled his meager savings, and 2 days later they cashed in. His share of the profit was a mere $3.12. But in that small sum was the seed of a fortune. It was the first tangible proof that his method worked. From that moment on, he became a speculator on his own. He found his arena in the bucket shops of Boston, clandestine establishments where a trader did not actually buy or sell stock, but simply bet on the price fluctuations as they were printed by the ticker. This environment was perfectly suited to his skills. There was no delay, no friction. The price was on the board in front of him. He could buy or sell on the instant, scalping small but sure profits with lightning speed. He was not backing opinions or a favorite stock. He was playing the arithmetic of the tape, a system he had perfected. He was so successful that it wasn't long before the money he made in his lunch hour dwarfed the wages from his brokerage job. He gave up his position. At 15 years old, he had his first $1,000, which he laid in cash in his mother's lap. Before he was 20, he had accumulated his first $10,000. This early success, however, was a double-edged sword. It forged his skills in tape reading, but it also bred a dangerous overconfidence. He was not beating the market, he was beating the shop. The game was simplified, sterilized. He didn't have to account for the impact of his own trading on prices, nor did he have to contend with the delays of executing an order on the floor of a real exchange. He was so good at this simplified game that the bucket shop soon grew tired of his winning. They began to refuse his business, calling him the boy plunger. He was forced to change brokers constantly, even resorting to fictitious names to get his trades accepted. This relentless success was, in reality, a limitation. It taught him one dimension of a multidimensional game, and this lesson would prove to be excruciatingly expensive. At the age of 21, having exhausted the bucket shops of his hometown, he arrived in New York, the epicenter of the financial world. He came with $2,500 and a conviction that he had mastered the game. He sought out a reputable New York Stock Exchange house, a place where the only limit to his trading would be the size of his stake. The atmosphere was familiar, the huge quotation board, the clicking ticker, the crowd of customers. It looked like the same game, so he played it in the same way. He jumped in and out, scalping for small profits, just as he had done in Boston. The result was catastrophic. On his very first day, in just 2 hours of trading, he lost exactly $1,100, nearly half his stake. This was the beginning of the hard part. He was now paying the price for his specialized but incomplete education. He soon realized that there was something profoundly wrong with his play, but he couldn't spot the exact trouble. In a legitimate brokerage, the tape was telling ancient history. The price of a stock on the ticker might be 105, but by the time his order to sell reached the floor of the exchange, the real price might be 103 or lower. The instantaneous execution he relied on was gone. Furthermore, his own orders, if large enough, would further depress the price, an effect he never had to consider in the bucket shops where he was merely betting against the house. He was playing a new game with old, unsuited rules. It took him 6 months to lose everything he had brought to New York, and even to go into debt to his brokers. He was broke. This was the first of several times he would find himself in this position. Each time, the process of rebuilding was an agonizing lesson in humility and a testament to his resilience. He knew there was nothing wrong with him, only with his play. To get a new stake, he had to return to the only environment he knew he could beat. He borrowed $500 from his broker, A.R. Fullerton, and went to St. Louis, home to two of the largest bucket shops in the country. His one fear was being recognized. He started cautiously, but his skill was too great. In just 2 days, he made $2,800. But on the third day, the manager called him in. "Listen, kid," the owner said, pointing to the room full of customers. "There's 300 of them, 300 suckers. They feed me and my family. Then you come in, and in 2 days, you cop more than I get out of the 300 in 2 weeks. That ain't business, kid. Not for me." He was thrown out. He tried the next shop, only to be recognized and refused business before he could make a single trade. He returned to New York, and the cycle of winning, losing, and learning continued. He would make money. The struggle for that first substantial, lasting stake of year campaign. It was hard because he was fighting against his own ingrained habits, against a market that was far more complex than he had ever imagined, and all with insufficient capital, where every misstep was a potential death blow. He learned that there is nothing like losing all you have in the world for teaching you what not to do. And when you know what not to do in order not to lose money, you begin to learn what to do in order to win. Every loss was a tuition payment. He confessed that his losses taught him he could not begin to advance until he was sure he would not have to retreat. Each time he was wiped out, he added a brand new "don't" to his arsenal of market wisdom. The first $10,000 was hard because it represented the cumulative cost of this brutal education. It was the price of unlearning false assumptions, of discovering the true nature of speculation, and of surviving long enough to put those lessons into practice. The money itself was secondary. The real prize was the experience, the collection of valuable don'ts that he had paid for with his own financial blood. That foundation, built on the bedrock of failure, was what made the next million not only possible, but profoundly easier. With the brutal but necessary education of the bucket shops and his early New York failures behind him, Jesse Livermore had finally paid the steep price of admission to the real game of speculation. The first $10,000 earned through a relentless cycle of small wins and catastrophic losses was more than just money. It was his diploma from the School of Hard Knocks. It was the capital that bought him his most precious asset, the luxury of thought. For the first time in his career, he was no longer a desperate gambler fighting for survival, chained to the minute-by-minute fluctuations of the tape. He could afford to be a student, a strategist, and above all, a patient hunter waiting for the perfect moment to strike. This transition, from a frantic struggle for existence to a calm and deliberate campaign for fortune, was the pivotal point in his entire career. It was the moment he stopped being a player and started becoming the house. The game changes entirely when a speculator is properly capitalized. Without adequate reserves, a trader is forced into a defensive posture. He cannot afford to take even a small loss, for it eats into his very survival. He cannot afford to wait for the true opportunity, for he feels the constant pressure to make money now to cover his expenses. This desperation forces him into overtrading, into making bets on minor movements, and into a state of constant anxiety. Livermore had lived this life for years. His disastrous first attempts with cotton, where he repeatedly jumped in before the market was ready and was shaken out by his own impatience, were a direct result of this pressure. He was trying to force a profit from a market that was not yet ready to give one. But with a proper stake, the chains fall away. A speculator can afford to make what Livermore called exploratory bets. He could test the market with a small initial commitment, and if he was wrong, he could take the small loss without a second thought. This was not a failure, it was the cost of information. It was a probe to determine the market to take this cold-blooded, dispassionate attitude. The ability to afford a few minor losses is essential for building the confidence to place the big bet when the time is right. Livermore now had this ability. He could wait for weeks or even months if necessary, for the market to align perfectly with his analysis. This patience, a luxury he had paid for with his earlier losses, was the new cornerstone of his strategy. This newfound freedom allowed him to make the single most important intellectual leap of his life. He stopped being a simple tape reader and became a student of general conditions. He began to realize that the big money was not a hand in Fullerton's office, where an old trader they called Turkey would respond to every tip and every frantic question with the same serene statement. Well, this is a bull market, you know. At the time, Livermore didn't fully grasp the depth of that wisdom. But as he reflected on his own failures to make significant money even when his analysis was correct, the meaning became clear. Old Man Partridge was not interested in the ripples. He was riding the tide. He understood that in a great bull market, the primary force is upward, and the intelligent play is not to jump in and out taking small profits, but to buy and hold, to sit tight until the fundamental conditions that created the bull market began to change. Livermore realized that this was his own critical mistake. He would be bullish from the start of a bull market and back his opinion by buying stocks. But then he would listen to the elder statesman in the brokerage office and curb his youthful impetuousness. He would take a 4-point profit and wait for a reaction that never came, only to watch his stock soar another 10, 20, or 30 points without him. They say you never go poor taking profits, he reflected. No, you don't. But neither do you grow rich taking a 4-point profit in a bull market. The game was not to scalp, but to correctly diagnose the trend and have the courage to stay with it. This shift in perspective, from focusing on individual stocks to sizing up the entire market and its trend, was the beginning of his journey toward millions. This evolution in thought from reacting to the tape to anticipating the market's next major campaign is a journey every great speculator must make. It is the transition from being a tactician to becoming a strategist. While Livermore arrived at this conclusion through his own painful experience and observation, another market genius of his era, Richard Wyckoff, was developing a systematic methodology to do precisely that. Wyckoff taught his students to see the market as the work of a single mind, which he called the composite man. This composite man, representing the smart money and insiders, would carefully plan and execute his campaigns through distinct phases. Accumulation, where he quietly buys stock from the uninformed public. Markup, the sustained upward trend that Livermore learned to ride. Distribution, where the composite man sells his holdings to an eager public at the top. And markdown, the subsequent decline. If Livermore's great insight was understanding that he needed to follow the big swing, Richard Wyckoff's genius was in creating a detailed roadmap to identify how that swing develops. He provided the tools to read the story of supply and demand on the tape, to see the signs of accumulation before the markup phase began, and to recognize the subtle warnings of distribution before the inevitable markdown. Wyckoff's methods provide a logical structure for the principles that Livermore discovered through instinct and trial and error. For any trader who wishes to move beyond simply following prices and truly understand the forces that drive them, the Richard Wyckoff Trading Methods channel is an essential educational resource. It provides a deep dive into this powerful methodology, offering a framework to anticipate and not just react to the market's next great move. You can find the link in the description. Armed with sufficient capital and this new profound understanding of the market's nature, Livermore was finally able to implement his own set of trading rules, rules that were designed not to catch small profits, but to capture the heart of the major movements. These were the working tools that his hard-won education had prepared him to wield. The first of these was his refined concept of the pivotal point. He had always noticed that stocks showed unusual strength after crossing key levels like 100 or 200. Now he made this observation a cornerstone of his strategy. He would patiently wait for a stock he had analyzed to reach and decisively cross such a point before making his first commitment. This required immense discipline. He described waiting for weeks as Bethlehem steel climbed from the 80s towards 100. Every point it advanced was money he wasn't making. But he held himself in leash, waiting for the exact psychological moment. When the stock finally crossed 100, he bought and was rewarded with a breathtaking rise of nearly 50 points in 5 days. He had learned to trade not when he wanted to, but when the market told him the time was right. The second rule was his method of pyramiding. Having made his initial commitment at the pivotal point, he would add to his line, but only on a rising scale. Each new purchase had to be at a higher price, confirming his initial judgment and the strength of the trend. This practice, so alien to the amateur who loves to average down, ensured that he was most heavily invested only when he was most certainly right. It kept him from throwing capital base, as it required adding to a position and forgoing the false comfort of buying bargains on an insurance premium against a much larger loss. If he made an exploratory trade and it immediately showed a loss, he didn't hope or wait. He got out. The market was telling him he was wrong, or at least that his timing was off. He would take the loss and wait for a better opportunity. This discipline preserved both his financial and his psychological capital. It kept him in the game, ready to act with a clear mind when the true, low-risk opportunity finally presented itself. These rules, waiting for the pivotal point, pyramiding on strength, and ruthlessly cutting losses, were the practical application of his new philosophy. They were the mechanics that enabled him to move from making hundreds of dollars in the bucket shops to commanding hundreds of thousands on Wall Street. The game was no longer a desperate scramble for pennies. It was a calculated strategic campaign. The first $10,000 had been the brutal price of learning these lessons. It was the capital that bought him a seat at the table. Now, with the rules of the game finally understood, he was ready to play for the entire pot. The intellectual and financial foundation was laid. The era of mastery and the first million was about to begin. The final barrier between the struggling speculator and the master operator is not a financial number, but a state of mind. The journey to the first $1 million becomes easier, not because the market becomes more generous or the game less perilous, but because the trader himself is fundamentally transformed. With sufficient capital, a tested method, and the hard-won discipline of emotional control, the speculator sheds the skin of a frantic gambler and dons the calm mantle of a business strategist. The game slows down. He is no longer fighting the market, and more importantly, he is no longer fighting himself. The millions, when they come, are not the result of a lucky guess or a desperate lunge for riches. They are the logical, almost inevitable wages of mastery. This transformation was the true source of Jesse Livermore's power. He was no longer a participant tossed about by the chaotic waves of the market. He had become a student of the tides themselves. He understood that the greatest battles were not against bull cliques or bear pools, but against the twin enemies that reside within every trader, hope and fear. His journey had taught him to reverse these natural impulses. He learned to fear when he had a loss, however small, and to hope when he had a profit, however large. He learned that profits take care of themselves, but losses never do. This psychological fortitude, built upon the ruins of his earlier failures, was his unbreachable fortress. He was no longer swayed by tips or rumors. He had learned through costly experience the folly of acting on another man's information. Beware of inside information. All inside information became a creed written on the first page of his notebook and etched into his mind. The industrialist friend who tells you when to buy, he knew, would never tell you when to sell. A speculator must do his own seeing, his own thinking. This independence of thought, combined with his now ample capital, allowed him to play for the one thing that mattered, the big swing. He was no longer concerned with making a living day to day. He was concerned with being right on the great movements. The ultimate test and vindication of this transformation came in 1907. This was not a trade. It was a campaign, the culmination of everything he had ever learned. For months he had been studying the general conditions, and his analysis pointed to one inescapable conclusion. The monetary situation was becoming critical. The rampant speculation and industrial expansion had stretched the credit system to its breaking point. He saw the storm cloud forming long before the first drop of rain fell. He knew a great decline was not just possible, but inevitable. This was not a hunch. It was a diagnosis based on a cold, dispassionate study of economic facts. But his earlier costly mistakes had taught him a final, crucial lesson about timing. Even when one is properly bearish at the very beginning of a bear market, it is folly to begin selling in bulk until the market itself is ready. His first attempts to short the market in 1906 had been premature. The engine of the bull market, though sputtering, still had enough momentum for rallies that were powerful enough to wipe him out. He was right on his thesis, but wrong on his timing, and the market had punished him for his impatience. He was nearly cleaned out. He had seen the pile of dollars ahead, but had started sprinting too soon and had fallen, exhausted, before he could reach it. This time he waited. Broke but not broken, he watched with the patience of a predator, waiting for the unmistakable signal. It came not from the tape, but from the financial pages of the newspapers. The Great Northern and Northern Pacific Railroads announced a new issue of stock, offering it to stockholders on an installment plan. This was unprecedented. For years, the right to subscribe to new issues had been a valuable melon, eagerly paid for in cash. But the most powerful banking houses in the country were now unsure if stockholders could pay cash for a bargain, was a signed confession of the profound sickness in the money market. A few days later, the St. Paul Railroad announced its own issue, with a payment date set ahead of the other two, a frantic scramble to get to what little money was left. For Livermore, this was the final, irrefutable confirmation. The time for doubt was over. The time to act was now. He began to sell. Not recklessly, but deliberately, testing the market, adding to his line on weakness, following his own rules. His earlier mistakes had taught him how to pyramid a short position just as he would a long one, selling at successively lower prices. The market was soft as mush. The rallies grew feebler and feebler. He was no longer guessing. He was anticipating the inevitable. His true allies, he felt for the first time, were underlying conditions. They were helping him with all their might. He was short of the market, heavily short, and he was right. The climax arrived on October 24th, 1907. The money market, which had been gasping for weeks, finally suffocated. There was no money to be had at any price. Hell broke loose on the floor of the exchange. Stocks for which there had been bids moments before now found no buyers at any price. It was a vacuum, a black hole of panic. While brokers ran around in terror and the pillars of Wall Street rushed to J.P. Morgan for a bailout, Livermore was calm. This was the moment he had foreseen, the moment he had planned for. That day, his winnings exceeded $1 million, but the money was almost an afterthought. The real victory was something far greater. As he later reflected, his biggest winnings were not in dollars, but in the intangibles. I had been right, he said. I had looked ahead and followed a clear-cut plan. I had learned what a man must do in order to make big money. I was permanently out of the gambler class. I had at last learned to trade intelligently in a big way. This was why the million was easier. It was not a lottery ticket. It was the earned profit of a master craftsman. He had conquered the market because he had finally, after years of brutal struggle, conquered himself. This incredible journey from a boy chalking numbers on a board in a bucket shop to the man whose actions could steady a panicked market is more than a story about making money. It is a saga of human struggle, intellectual growth, and the relentless pursuit of mastery. It is a journey into the mind of a speculator. And there is no greater guide to that journey than the book that has become a timeless classic for traders worldwide. Edwin Lefebvre is not simply a biography. It is a psychological thriller, a deep dive into the internal battles with hope, greed, and fear that define a trader's life. It captures the very essence of the game. Yet to fully unlock its secret, chapter-by-chapter analysis by Max Davidson, it is an indispensable companion, a guide that deciphers Livermore's timeless principles, breaks down his strategies, and illuminates his psychological insights, making them profoundly relevant and powerfully actionable for the modern speculator. If you are ready to move beyond simply reading the story and begin truly living its lessons, the link in the description is your next step.
Defend why you broke your last trade, you'd give me reasons. Good reasons. The market looked different. The setup wasn't quite right. You had a feeling, but here's what I've learned after decades of working with traders. Every single justification you offer is a fabrication created after the fact to explain a decision your conscious mind didn't actually make. Your rational brain wasn't in the driver's seat when you clicked that button. Something else was. And until you stop accepting your own false testimony about why you do what you do, you'll never be able to change it. I'm about to show you how to cross-examine yourself properly, how to get past the lies your mind tells you, and uncover the real defendant. Now, here's what this video is really about, and why it's completely different from every other trading psychology lesson you've ever encountered. Most trading education tells you the solution to breaking your plan is more discipline, better habits, stronger rules, or mental. They're essentially telling you to build a bigger cage to contain your behavior. They're telling you to force yourself into compliance. But I'm going to show you something that will completely reframe how you understand this problem. You don't break your plan because you're weak. You don't break it because you lack discipline. You break it because you're internally conflicted, and conflict always resolves in favor of the strongest belief. Always. The pain you're experiencing right now, that frustration, that self-judgment, that feeling that you're sabotaging yourself, it all comes from not understanding what's happening beneath your conscious awareness. You think you're failing at execution. You think there's something wrong with you. But what's actually happening is your subconscious belief system is protecting you from what it perceives as more dangerous than a financial loss. And I know that sounds strange. I know it. Sounds counterintuitive. But stay with me, because once you see this clearly, everything changes. Here's the myth I'm going to completely dismantle over the next hour, that following your plan is about controlling your impulses. It's not. It's about eliminating internal conflict so there's nothing to control. Think about that for a moment. When you're truly aligned internally, when there's no conflict between what you believe and what you're doing, there's no struggle, there's no willpower required, you just act naturally, easily, consistently. What makes this perspective unique, what makes it different from everything else you've heard, is that I'm not going to teach you techniques to force yourself into compliance. I'm not going to give you mantras or visualization exercises or morning routines. I'm going to help you understand the two specific psychological mechanisms that create the conflict in the first place. And once you see them clearly, once you really see how they work, the struggle ends. Not because you become more disciplined, but because you've removed the beliefs that make discipline necessary. This video is going to give you emotional relief. Not because I'm going to motivate you, not because I'm going to pump you up, but because I'm going to show you that you're not broken. You're not self-destructive. You're not weak-willed. You're simply operating with beliefs that make consistent execution impossible. And beliefs, once you understand how they work, can be changed. By the end of this video, you'll understand exactly why you do what you do. You'll see the precise mechanism that activates in the seconds before you override your rules. and you'll have a clear path to internal consistency that doesn't require willpower, force, or fighting yourself. You'll understand that you've been trying to solve the wrong problem your entire trading career. So let me start by painting you a picture. I want you to imagine you're the pilot of an aircraft. You've been trained extensively. You know every instrument, every procedure, every emergency protocol. You've studied meteorology. You understand aerodynamics. You've logged hundreds of hours. You've written a detailed flight plan for this journey. You're confident. You're prepared. You're competent. You take off. Everything's going smoothly. The weather's clear. Your instruments are reading normally. You're following your flight plan exactly. But then, 20 minutes into the flight, you notice something strange. The plane starts deviating from your planned course. Not dramatically, not in a way that seems dangerous, just a slight course change. A few degrees off, you notice it and you correct it manually, you adjust your heading, you get back on course, everything seems fine. But then, a few minutes later, it happens again. Same deviation, same direction, you correct it again. You're starting to feel a little irritated now. Why does this keep happening? You check your instruments, everything looks normal. You check your calculations, your flight plan is solid, but the deviations continue, and they're not random, they're consistent. The plane keeps trying to go in a direction that's different from your plan. You correct it again and again and again. You're getting frustrated now, you're getting tired, you're thinking, why is this so hard? Why can't I just fly the plane according to my plan? What's wrong with me? Finally, after the 10th or 15th correction, you discover something, you look deeper into your systems, and you realize there's an autopilot system running in the background that you didn't know was engaged. And this autopilot is programmed, it has a different destination, different waypoints, different altitudes, a completely different route. Now, here's the critical part, and I need you to really understand this. This autopilot is not malfunctioning. Its autopilot is not broken. It's not operating randomly. It's doing exactly what it was programmed to do. It's following its plan perfectly. The problem is not the autopilot. The problem is that its plan and your plan are in direct conflict. And every time you manually override it, every time you correct the course, it waits a few minutes and then it engages again. Because from its perspective, you're the one who's off course. You're the one who's deviating from the plan. It's trying to help you. It's trying to protect you. It's trying to take you to what it believes is a safe destination. This is what's happening every single time you break your trading plan. You have a conscious plan, your rules, your strategy, your risk parameters, your entry and exit criteria. That's your manual flight plan. It makes sense. It's logical. It's based on an edge. It has positive expectancy. You believe in it intellectually, but you also have a subconscious autopilot running in the background. And this autopilot is programmed with beliefs. Beliefs about what's dangerous, beliefs about what's safe, beliefs about what needs to be avoided at all costs, beliefs about what winning and losing mean, beliefs about who you are and what you're capable of. And these beliefs, these programs, they're running constantly beneath your conscious awareness. When these two systems conflict, when your conscious plan says take this trade and your subconscious belief system says this is dangerous, avoid it, the autopilot always wins. Not because you're weak, not because you lack discipline, but because the autopilot operates faster than conscious thought. It has direct access to your emotional circuitry. It can override your logic in milliseconds. It can create feelings of fear, anxiety, doubt, hesitation, and your conscious mind will then create rational sounding explanations for those feelings after the fact. Most traders spend their entire careers fighting the autopilot. They try to manually override it again and again. They beat themselves up for deviating. They promise themselves they'll do better next time. They create more rules, more structure, more discipline, but they never realized they could simply reprogram the autopilot. They never realized that if they changed the underlying beliefs, the conflict would disappear. So the question becomes, what exactly is this autopilot programmed with? What beliefs are running your trading decisions without your conscious awareness? And how do you identify them? How do you see them clearly enough to change them? Let me tell you about a pattern I observed over and over again when I worked directly with traders. I'd be on the phone with someone or sitting across from them in a consultation, walking them through their trading plan. They'd explain their edge to me. They'd explain their rules, their risk management, their position sizing. Everything would make perfect logical sense. They'd understood probabilities. They knew that no single trade mattered. They knew the math worked over a series. They could articulate all of this clearly. Then I'd ask them to describe the last time they broke their plan. And what I'd hear was absolutely fascinating. Mid-sentence, their voice would change. Not metaphorically, not in some abstract psychological way. Literally, the tone would shift, the pace would change. The emotional quality would transform completely. They'd start with something like, well, I had my stop set at this level, and I knew I should take it, but then I saw the price action, I thought, and right there, in that word, but, a completely different identity took over the narrative. A completely different self started speaking. The voice that planned the trade was calm. It was logical. It was rational. It was probabilistic. It talked about edge and expectancy and risk-reward ratios. But the voice that executed the trade, or failed to execute the trade, was urgent. It was personal. It was afraid. It wasn't talking about probabilities anymore. It was talking about this specific trade as if it carried meaning beyond its mathematical expectation. And I'd hear things like, I just couldn't take the loss. Not, I didn't execute my stop according to plan, but I couldn't. As if something was preventing them. As if there was an actual barrier, and there was. The barrier was the conflict between two different belief systems operating in the same mind. Here's what I realized after hearing this pattern hundreds of times. We don't have one unified self making trading decisions. We have multiple selves, each with different beliefs about what's important, what's dangerous, and what needs to be protected. The self that writes your plan is thinking probabilistically over a series of trades. It understands that any individual trade is meaningless. It knows that losses are part of the process. It accepts uncertainty as a fundamental characteristic of the market. But the self that executes your plan is thinking personally about this one outcome, this one trade. Right now, and it's asking questions like, what if I'm wrong? What if I lose? What will that mean about me? What will I feel? How will I handle it? It's not thinking probabilistically. It's thinking emotionally. It's thinking in terms of pain and safety and self-protection. And here's the painful part. Both of these cells believe they're helping you. Your planning self thinks it's protecting you from ruin by creating structure, by defining risk, by calculating expectancy. Your executing self thinks it's protecting you from something worse than financial loss. It thinks it's protecting you from being wrong, from looking foolish, from feeling the discomfort of uncertainty, from confirming beliefs about yourself that you don't want to be true. The reason you keep breaking your plan is because you're trying to execute a probabilistic plan with a personal identity. It's like trying to run scientific software on emotional hardware. The system isn't compatible. You need to either change the plan to match your beliefs or change your beliefs to match the plan. And since changing the plan means abandoning your edge, the only real option is to change the beliefs. Now, let me tell you about a specific trader I worked with because this story illustrates the mechanism so clearly. I'm going to call him David, though that's not his real name. David came to me because he had an unusual problem. He couldn't lose. And I don't mean he never had losing trades. He had plenty of them. What I mean is he couldn't experience a loss as just a loss. He couldn't accept it as a neutral event. Every loss meant something to him personally. David was a smart guy. He had an engineering background. He understood statistics. He knew that losses were inevitable. He knew that his strategy had a 65% win rate, which meant that 35% of his trades would lose no matter what. He understood this intellectually, but emotionally, every loss felt like evidence, proof, a confirmation of a belief he carried his entire life. I'm not good enough. Now, where did this belief come from? It came from his childhood. His father was extremely critical. Nothing David did was ever good enough. He'd bring home a test with 95%, and his father would ask about the 5% he got wrong. He'd win second place in a competition, and his father would ask why he didn't win first. The message was constant and clear. You're not measuring up. You're not good enough. David spent his whole life trying to prove that belief wrong. He worked harder than everyone else. He achieved more than his peers. He was successful by any external measure. But internally, he was still that little boy trying to earn his father's approval. And that belief, I'm not good enough, was still running in his subconscious autopilot. So here's what would happen when David traded. He'd take a trade. If it went in his favor, he'd feel temporarily relieved, See, maybe I am good enough. Maybe I can do this. But if it went against him, his subconscious would immediately scan for ways to avoid confirming that core belief. And it found one. This isn't a real loss. Not yet. If I hold it, there's still a chance it comes back. As long as I haven't closed it, I haven't actually failed. So he'd hold, and he'd hold, and he'd hold. He'd move a stop. He'd tell himself he needed more information. He'd average down. He'd do all kinds of mental gymnastics to avoid facing that moment of confirmation. That moment when he'd have to close the trade and accept that he was wrong. Because to his subconscious, being wrong in the market meant the same thing as being wrong in his father's eyes. It meant you're not good enough. Now, from the outside, this looks like poor risk management. It looks like he's being undisciplined, reckless, self-destructive. Friends would tell him, just take the stop, just follow your rules, and he'd nod and agree and promise to do better. But the next time, the same pattern would repeat. Because from the inside, from his subconscious perspective, he was being perfectly rational. His subconscious had done the math. It had calculated a large financial loss is painful, but it's temporary. I can make the money back. But confirming the belief that I'm not good enough, that's permanent. That's unbearable. That's what I've been trying to avoid my entire life. Therefore, I will risk the temporary pain of a financial loss to avoid the permanent pain of confirming my inadequacy. You see what's happening here? David wasn't afraid of losing money. He was afraid of what losing money meant. His subconscious had attached his self-worth to his trading results. And once that attachment exists, once that connection is made, consistent execution becomes impossible. Because every trade becomes a referendum on your identity. Every loss becomes a judgment on your worth as a person. We worked together for months. And here's what finally shifted things for David. It wasn't about teaching him more discipline. It wasn't about giving him better risk management rules. It was about helping him see that a loss in the market is just information. It's just feedback about probability distribution. It's not evidence about who he is. It's not a statement about his worth or his confidence or his adequacy. A loss in the market means one thing and one thing only. The market did something other than what you thought it might do. That's it. It doesn't mean you're stupid. It doesn't mean you're not good enough. It doesn't mean you'll never be successful. It means probability expressed itself in one particular way, and if you have an edge, probability will express itself differently next time, or the time after that, or the time after that. Once David separated his self-worth from his trading results, once he truly understood at a deep level that these two things had nothing to do with each other, his execution transformed overnight. Not because he became more disciplined, not because he gained more willpower, but because there was no longer any internal conflict to resolve. His conscious plan and his subconscious beliefs were finally aligned. This brings us to the core of everything I want to teach you. The two things, the two mechanisms that create all of the conflict, all of the inconsistency, all of the plan violations, once you understand these two mechanisms, once you see them operating in your own mind, you'll be able to dissolve them. And when you dissolve them, consistent execution becomes natural. The first mechanism is what I call the meaning attachment system. This is the one that causes about 80% of all plan violations. Here's how it works. You've attached personal meaning to individual trade outcomes. You've taken random market events and you've connected them to your self-concept, your identity, your worth as a person. And when you were young, your brain learned to survive by detecting patterns and assigning meaning to events. This was useful. If you touched a hot stove and got burned, your brain created a meaning. This is dangerous, avoid it. That meaning protected you. It kept you safe. If you said something and your parents got angry, your brain created a meaning. This behavior causes pain, don't do it again. That meaning helped you navigate your social environment. Your brain is still doing this. It's still looking for patterns and assigning meanings. That's its job. That's how it helps you survive. But here's the problem. It's trying to do this in the market. It's trying to assign meaning to randomness. It's trying to find patterns in probability distributions. And worse, it's linking market outcomes to your self-concept. Let me give you the most common meanings traders attach to losses. See if you recognize any of these in yourself. If this trade loses, it means I was wrong. If I take a loss, it means I failed. If I have 3 losses in a row, it means my strategy doesn't work. If I don't make money today, it means I'm not a good trader. If I lose on this setup again, it means I don't know what I'm doing. Do you hear what's happening in each of these statements? The market outcome has been elevated from a probabilistic event to a statement about identity, competence, and worth. The loss is no longer just a loss. It's evidence. It's proof. It's confirmation of something you believe about yourself. Once this attachment exists, once this connection is made, your subconscious has to protect you from these meanings. That's its job. It's trying to help you. It sees these meanings as threats to your psychological safety, and it will do whatever it takes to help you avoid confirming them. And the way it protects you is by helping you avoid, deny, or escape situations where those meanings might be confirmed. So you break your plan. You don't take the trade, because if you take it and it loses, you'll be wrong. You move your stop, because if you take the loss, you'll have failed. You close the winner early, because if you hold it and it turns into a loss, you'll have made a mistake. You hold the loser too long, because as long as it's open, you haven't actually failed yet. That all of these behaviors, every single one of them, is not evidence of poor discipline. It's evidence of meaning attachment. Here's the paradox, and this is really important. The more you care about being right, the worse your execution becomes. The more you need to avoid being wrong, the more you interfere with your edge. The tighter you hold on to control, the more chaos you create. It's completely backwards from what most people think. Most people think caring more will make them better. They think if they just care more about their results, if they just want it more, if they just try harder, they'll improve. But in trading, the opposite is true. The more you care about individual outcomes, the more you contaminate your execution with emotional interference. Now, let me show you how to dissolve this attachment. The core reframe is this. A single trade outcome means nothing about you, your intelligence, your confidence, or your future. Nothing. It is one sample in a probability distribution. That's all it is. That's all it can ever be. Think about it this way. If you flip a coin and it lands on tails, does that mean you're bad at flipping coins? Of course not. It means probability expressed itself. If you flip it again and it lands on tails again, does that mean the coin is broken? Does it mean you're doing something wrong? No. It means you experience two independent events, each with a 50-50 probability. If you take a trade with a 60% win rate, does it mean your strategy doesn't work? No. It means you experience the 40%. That's all. Nothing more, nothing less. If you take it again and it loses again, you've experienced two instances of the 40%. That doesn't change the underlying probability. The edge is still there. The expectancy is still positive. You just experienced probability distribution. Your job as a trader is not to be right on any given trade. Your job is not to avoid losses. Your job is not to predict the market. Your job is to execute your edge consistently over a series of trades and let probability distribution do what it does. That's it. That's the whole game. But in order to do that, you have to stop attaching meaning to individual outcomes. You have to see each trade as what it truly is, one sample in a distribution, one data point in a series, one expression of probability among thousands. Here's a practice I want you to start doing immediately. Before every trade, before you click the button, I want you to say this out loud. This trade is one sample in a distribution. Its outcome carries no meaning about me. I am here to execute my edge, not to be right. And after every loss, every single time you take a loss, I want you to ask yourself this question. What meaning am I attaching to this outcome? Be honest. Don't lie to yourself. Don't give me the answer you think you should give. Give me the real answer. If you find yourself thinking I was wrong, or I failed, or I'm not good at this, you've identified the meaning attachment. And once you've identified it, you can start to question it. Ask yourself, is this meaning true? Does one trade outcome really determine my competence? Does it really prove anything about my future? The answer is always no. Always. One trade proves nothing. 10 trades prove nothing. Even 100 trades don't prove much of anything. You need thousands of samples before you can draw meaningful conclusions about edge. But your brain wants to assign meaning immediately after one event, because that's how it protected you as a child. The second mechanism that causes plan violations is what I call the certainty addiction system. Your brain is addicted to certainty, and the market offers none, ever. Let me explain what I mean by this. Human beings are wired to seek certainty. We feel safe when we know what's going to happen. We feel anxious when we don't. This made perfect sense evolutionarily. If you were walking through the forest and you heard a rustling in the bushes, You didn't know if it was wind or a predator. The safest assumption was predator. Better to be wrong about the wind than to be wrong about the predator. So we evolved to be extremely uncomfortable with uncertainty. We evolved to seek certainty as a survival mechanism. But trading requires you to act in a state of permanent uncertainty. Permanent. You can never know what will happen next. Ever. No matter how good your analysis is, no matter how strong your setup is, no matter how many indicators line up, no matter how much confluence you have, the next outcome is unknowable. It's fundamentally, completely, absolutely unknowable. And this creates a profound psychological discomfort. Your brain is screaming at you, get me certainty, show me proof, make me safe. Don't take action until you know what's going to happen. It's trying to help you. It's trying to protect you. But it's asking for something that doesn't exist. So what does your brain do? It searches for certainty where none exists. It starts pattern matching. It starts assigning predictive power to things that have no predictive power. It starts creating narratives about what the market should do based on what it did last time, or what it typically does, or what makes logical sense. It creates the illusion of certainty to make you feel safe enough to act. But here's the problem. Every time you wait for certainty before you act, you're reinforcing the belief that certainty is necessary. And every time you act on false certainty, on the illusion of knowing, you're reinforcing the belief that certainty is possible. Both of these beliefs make consistent execution harder. Let me show you how this plays out in real trading. You have a trade set up, your rules say take it, the edge is present, everything lines up according to your plan. But your brain says, wait, are you sure this one will work? Let me gather more information. Let me wait for one more confirmation. Let me see if the next candle confirms the direction. So you hesitate, you wait, you want to be more certain. And while you're waiting, the trade moves. It goes without you. Now, you're in a worse position. Do you chase it? Your rules say no, but you feel like you missed an opportunity. You feel frustrated. Your brain says, see, you weren't certain enough. You need better confirmation next time. You need to be more sure. So next time, you wait for even more confirmation. But by the time you get it, the best part of the move is over. And if you enter late and it doesn't work, your brain says, see, you still weren't certain enough. You need to wait for even more confirmation. Do you see the trap? You're creating a standard of certainty that can never be met because certainty doesn't exist. Or the opposite happens. You take the trade, your rules are clear, your stop is defined, but the trade goes against you. It moves toward your stop. Your brain says, wait, maybe this is just temporary. Maybe it will come back. Let me stay in a little longer to see if I can get more certainty about the direction. I'll know in just a few more minutes whether this is a real loss or just a temporary pullback. So you wait for certainty about whether you should take the stop. But the market doesn't care about your need for certainty. It keeps moving. The loss gets bigger. Now you're in an even worse position. Do you take the stop now? Your rules say yes, but your brain says, I've already held this long. Let me just wait a little longer. Maybe it will come back. I just need a little more certainty. Do you see what's happening? You're waiting for certainty before you act, but the market will never give it to you. Every time you wait, you're in a worse position. Every time you hold for more information, you're taking more risk. Every time you demand certainty, you're actually creating more uncertainty about your results. Here's the brutal truth, and I need you to really hear this. The market doesn't care about your need for certainty. It doesn't care about your comfort. It doesn't care about your feelings. It's going to do what it does based on the collective actions of millions of participants, most of whom are also confused, also uncertain, also afraid. The market is a probability distribution. That's all it is. Sometimes your edge will express itself, sometimes it won't. Sometimes you'll win 3 in a row, sometimes you'll lose 5 in a row. Sometimes your win will be bigger than expected, sometimes your loss will hit your stop exactly. All of these outcomes are part of the distribution. All of them are normal. All of them are to be expected. The only certainty you can have in trading is this. If you execute your edge consistently over a series of trades, probability will work in your favor. That's it. That's the only certainty available. But your brain doesn't want statistical certainty over a series. It wants outcome certainty on this trade right now before you act. And that certainty is not available. It will never be available. So here's the reframe. Trading is not about knowing what will happen next. It's about executing a process that has positive probabilistic expectancy without needing to know what will happen. Not despite not knowing. Not even though I don't know, but without needing to know. There's a difference. Think about a casino. Does the casino know whether the next spin of the roulette wheel will land on red or black? No. It has no idea. Does it care? Edge to express itself over a series. The casino doesn't need to know what it knows the probabilities. It knows that if it just keeps offering the game, if it just keeps executing its edge consistently, the money will flow in its direction. I stop working on my edge. This is the paradox that stops most traders from fully embracing probabilistic thinking. They believe that caring less about outcomes means caring less about quality. But that's not what I'm saying. Not at all. I'm saying this. Care deeply about your process. Be completely indifferent to individual outcomes. These are not contradictory. They're complementary. Your process is within your control. Your analysis, your risk management, your position sizing, your entry criteria, your exit criteria, your trade selection. These are all things you can refine, improve, and master. Focus all your energy here. Work on your process every single day. More precise. But the outcome of any single trade, that's not within your control. It's determined by probability interacting with the collective actions of millions of other market participants, most of whom you'll never meet, many of whom are trading on different time frames with different objectives using different information. You cannot control what they do. You cannot predict how they'll react. You cannot know how probability will express itself on this particular trade. So why attach meaning to it? Why create internal conflict over something you can't control? Instead, put all your focus on what you can control. Execute your process. Follow your rules. Manage your risk. Let probability do its thing. And trust that over time, over a series, your edge will express itself and the money will flow in your direction. The moment you can separate these two things, caring about process while being indifferent to outcome, you become a consistent trader. Not because you've forced yourself into discipline, but because you've eliminated the internal conflict that made discipline necessary. There's no longer any struggle. There's no longer any fight. You just execute naturally, easily, consistently. Now, let me give you some practical tools for identifying and replacing the beliefs that create this internal conflict. This is not a motivational exercise. This is not a visualization technique. This is not a morning routine. This is a systematic process for examining your own belief system and making changes where changes are needed. The first thing you need to do is identify exactly what beliefs are running your subconscious autopilot. And the best way to do this is to examine your behavior after a plan violation. Not before, not during, after. Because after is when you have the most clarity. After is when you can look back and see the pattern objectively. So here's what I want you to do. The next time you break your plan, and there will be a next time, don't judge yourself. Don't spiral into self-criticism. Don't beat yourself up. Don't promise yourself you'll do better. None of that is useful. Instead, get curious. Become a scientist studying your own behavior. Become a detective investigating your own mind. Ask yourself this question. What was I afraid would happen if I followed my plan? Not what you think you should have been afraid of. Not what makes logical sense. What you were actually afraid of in that moment. Be honest. Brutally honest. Nobody's listening except you. Common answers I hear. I was afraid I'd be wrong again. I was afraid I'd feel stupid. I was afraid I'd miss out. I was afraid of the pain of another loss. I was afraid my doing account would get smaller. I was afraid people would judge me. I was afraid I'd prove to myself that I can't do this. Whatever your answer is, write it down. Get it out of your head and onto paper where you can look at it objectively. Then ask a second question. And if that happened, what would it mean about me? This is where you uncover the meaning attachment. This is where you find the belief that's creating the conflict. For example, if your answer to the first question was, I was afraid I'd be wrong again, then ask, and if I was wrong again, what would that mean about me? Your answer might be, it would mean I'm not good at this. It would mean I don't have what it takes. It would mean I'm wasting my time. There it is. That's the belief. Being wrong means I'm not good at this. Or if your answer was, I was afraid of the pain of another loss, ask, and if I felt that pain, what would it mean about me? Your answer might be, it would mean I'm failing. It would mean I'm losing money I can't afford to lose. It would mean I should quit. There's the belief. Losses mean I'm failing. Write the belief down. See it clearly, make it concrete. Because once you've identified it, once you've pulled it out of the shadows and put it in the light, you can start to question it. You can start to test it against reality. You can start to see whether it's actually true or whether it's just a story your mind is telling you. Ask yourself, is this belief true? Is it serving me? Does it help me execute my edge? The answer will almost always be no. The belief might have been useful at some point in your life. Maybe it protected you as a child. Maybe it helped you survive a difficult situation. Maybe it kept you from taking risks when you couldn't afford to take risks. But in the context of probabilistic trading, in the context of executing an edge over a series, it's creating conflict. It's interfering with your ability to act consistently. Once you've identified a limiting belief, once you see it clearly and recognize that it's not serving you, you need to replace it with a belief that supports consistent execution. You can't just remove a belief and leave a vacuum. Your subconscious will fill that vacuum with whatever's available. You need to intentionally install a new belief, a better belief, one that aligns with probabilistic thinking. For every limiting belief, create an empowering opposite. If the old belief is, if this trade loses, it means I was wrong, the new belief is, this trade has won. Outcome in a probability distribution, its result means nothing about me or my competence. If the old belief is, I need to be certain before I act, the new belief is, I can act without certainty because I have an edge that works over a series of trades. If the old belief is, losses mean I'm failing, the new belief is, losses are the cost of doing business as a trader. They're part of my edge expressing itself. They're necessary and expected. If the old belief is, I need to avoid being wrong, the new belief is, there is no such thing as being wrong in trading. There are only outcomes that fall within a probability distribution. Write these new beliefs down. Make them clear and specific. And then here's the critical part. You need to install them through repetition. Your subconscious doesn't learn through logic. It doesn't learn through understanding. It learns through repetition and reinforcement. You learn your old beliefs through years, sometimes decades, of repetition. You're not going to unlearn them overnight. But you can start the process. Before every trade, state the new belief out loud. This trade is one sample in a distribution. I don't need to know what happens next. I have an edge, and I trust it. After every trade, win or loss, state it again. When you feel the old belief activating, when you feel that familiar fear or hesitation or doubt, interrupt it and state the new belief over and over, consistently, repetitively. And here's something else that helps. Collect evidence that the new belief is true. Your brain needs evidence. It needs data. It needs proof. So give it proof. After every trade you execute according to plan, whether it wins or loses, write down, I executed my edge without needing certainty. I followed my process. I'm building trust in my system. Keep a journal of these. Over time, this evidence accumulates. Your brain starts to see that the new belief is not just a nice idea, it's reality. It's how the market actually works. Now, let me give you a final practice, something you can do before every single trade to ensure you're in a probabilistic state of mind. This is a pre-trade mental checklist. It becomes your ritual, your routine, your way of checking in with yourself before you click the button. Question 1, do I have my edge? This is simple. Yes or no? If yes, continue. If no, don't trade. Your edge is defined by your strategy, your rules, your entry criteria. If those things are present, you have your edge. If they're not, you don't. Don't trade without your edge, ever. Question 2, am I thinking in probabilities or am I thinking in predictions? This is critical. If you find yourself thinking this trade's going to work, stop. That's predictive thinking. That's outcome attachment. Reframe it. This trade has a probabilistic expectancy. Some will work, some won't. I don't need to know which this one will be. Question 3, am I attaching meaning to this outcome? If you feel like you need this trade to win, if you feel like it matters whether this particular trade works or not, stop. That's meaning attachment. This is one sample in a series. Its outcome is meaningless in the context of my edge. Question 4, am I okay with any outcome? This is the ultimate test. Can you take this trade and be genuinely okay if it hits your stop? Can you be okay if it wins big? Can you be okay if it chops around and goes nowhere? If the answer is no, if you're not okay with any outcome, don't trade. Because if you're not okay with any outcome, you're in conflict. You're hoping for one outcome and fearing another. And that hope and fear will contaminate your execution. Question 5. Am I executing this trade for the right reason? The right reason is because my edge is present. That's it. That's the only good reason. The wrong reasons are because I need to make back losses, because I'm bored, because I'm afraid of missing out, because I feel like I should be trading, because everyone else is making money, because I need to prove something. If you're trading for any reason other than edge presence, stop, wait. Come back when your edge is present and your mind is clear. If you can answer these 5 questions cleanly, you're ready to trade. If you can't, you're in conflict. And any trade you take will be contaminated by internal resistance. It's better to not trade than to trade in conflict, always. These practices, these protocols, they're not things you do once and forget. They're not magic bullets. They're things you do daily until they become automatic. In the beginning, it will feel mechanical. It will feel forced. You'll have to consciously work through the steps. You'll have to remind yourself. You'll have to catch yourself slipping back into old patterns. But over time, over weeks and months of consistent practice, they become part of how you think. The belief replacement becomes natural. The pre-trade checklist becomes intuitive. You'll find yourself automatically thinking in probabilities instead of predictions. You'll find yourself automatically separating meaning from outcomes. You'll find yourself automatically acting without needing certainty. And one day, maybe 3 months from now, maybe 6 months from now, maybe a year from now, you'll realize something remarkable. You'll realize you're no longer fighting yourself. You're no longer experiencing that internal tug-of-war between what you know you should do and what you actually do. You'll take your trades without hesitation. You'll take your stops without emotion. You'll follow your plan, not because you're forcing yourself, not because you're being disciplined, but because there's no part of you that wants to do anything else. That's internal alignment. That's what we're building toward. That's what changes everything. And it's not about becoming a robot. It's not about suppressing your emotions. It's not about becoming cold or detached. It's about becoming aligned. It's about having your conscious goals and your subconscious beliefs pointing in the same direction. When that happens, there's no struggle. There's no conflict. There's just execution. So let me bring this all together now. You came into this video probably thinking your problem was discipline. You thought you needed more willpower, more control, more rules, more structure. You thought there was something wrong with you. You thought you were weak or self-destructive or incapable of following a simple plan. But what I've shown you over the last hour is that your problem was never discipline. It was never willpower. It was never weakness. Your problem was internal conflict caused by 2 specific mechanisms, meaning attachment and certainty addiction. You were attaching personal meaning to random market outcomes. You were connecting your self-worth, your confidence, your identity to whether a particular trade worked or not. And your subconscious was protecting you from confirming painful beliefs about yourself by helping you avoid situations where those beliefs might be proven true. You were demanding certainty in an environment that offers none. You were waiting for proof, for confirmation, for guarantees before you acted. And the market was never going to give you what you were asking for. So you either hesitated and missed opportunities, or you acted on false certainty and were surprised when reality didn't match your expectations. Once you see these mechanisms clearly, once you understand how they work, the solution becomes obvious. Stop attaching meaning to individual outcomes. Stop demanding certainty before you act. Replace those beliefs with probabilistic thinking. Trust your edge to express itself over a series. Execute without internal conflict. This isn't about becoming a different person. This isn't about developing superhuman discipline. This is about seeing your own mind clearly and making simple adjustments to bring your beliefs into alignment with the reality of how markets work. That's it. That's the whole game. And here's what I want you to understand. What I really need you to hear. You are not broken. You're not defective. You're not lacking something that other successful traders have. You're just operating with beliefs that make consistent execution impossible. And beliefs can be changed. They can be examined, questioned, tested, and replaced. Every trader who's ever struggled with this has struggled for the same reasons you have. It's not personal. It's not unique to you. It's not evidence that you can't do this. It's just evidence that you're human, that your brain is trying to help you the only way it knows how, and that you haven't yet learned to think in the way that trading requires. But now you know. Now you've seen the mechanisms. Now you have the tools. Now you have a path forward. And that path doesn't require you to be perfect, doesn't require you to never make mistakes. It doesn't require you to execute flawlessly starting tomorrow. It just requires you to be aware, to notice when these patterns activate, to catch yourself attaching meaning, to recognize when you're demanding certainty, and to gently, consistently, repeatedly redirect yourself back to probabilistic thinking. So here's what I want you to take with you. Here's the core message. Here's the belief I want you to install. I am not defined by individual outcomes. I am defined by my ability to execute my edge consistently without internal conflict. I don't need to know what happens next. I don't need to be right. I just need to trust the process and let probability work. Say that to yourself right now. Say it out loud. Let yourself hear it. I am not defined by individual outcomes. I am defined by my ability to execute my edge consistently without internal conflict. I don't need to know what happens next. I don't need to be right. I just need to trust the process and let probability work. Write this down. Put it somewhere. You'll see it every day. Put it on your trading monitor. Put it in your journal. Put it on a sticky note on your bathroom mirror. Wherever you'll see it, and be reminded, because you need to reprogram that autopilot. You need to install this new belief through repetition until it becomes automatic, until it becomes just how you think. And listen, if this video resonated with you, if you felt something shift in how you understand your own trading behavior, I'd appreciate it if you'd hit the like button. It helps other traders who are struggling with the same patterns find this information. It helps this message reach people who need to hear it. Leave a comment too. Tell me which of these two mechanisms you recognized in yourself. Tell me what belief you're working on replacing. Tell me your story. I read every single comment, and I'm genuinely curious about your experience. You're not alone in this. Thousands of traders are going through exactly what you're going through. And there's value in sharing, in being honest about the struggle, in learning from each other. And if you want more of this, more deep psychological breakdowns of what really drives trading behavior, subscribe to the channel, because this is just the beginning. There's so much more to explore about how your mind works, how beliefs shape behavior, how to develop unshakable trust in your process. I'm here to help you understand yourself better so you can trade better, not by giving you strategies or setups, but by helping you eliminate the internal barriers that prevent you from executing whatever strategy you choose. You're not alone in this struggle. You're not broken. You're not failing. You're just learning to think in a way that aligns with how markets actually work. And that takes time. That takes practice. That takes patience with yourself. But it's absolutely possible. I've seen thousands of traders make this shift. I've watched them go from inconsistent and frustrated to consistent and calm. Not by gaining more discipline, but by eliminating internal conflict. You can do this. You really can. Not because I'm saying it to make you feel good, but because it's true. You already have everything you need. You just need to align your beliefs with your process. And now you know how. I'll see you in the next one.